Hi everyone, and welcome to Financial Basics, where we make money grow with you. Today I want to be talking about a little bit of a hot topic, precisely calculating your expenses using real numbers and actually not estimating, but actually calculating what those expenses are. So my advice here is do not estimate your expenses. And the reason for that is because a lot of the time you're going to have one-off expenses where they're either in a month's time or 2 months time or 3 months time, or they haven't occurred over the period that you're looking at, and you miss that, and that actually adds a substantial amount to your overall expenses. A lot of people also sit down and go, this is my rent, this is how much I spend on food, this is how much I spend on this, and they try and estimate what those numbers are without having any full context, and a lot of the time they get it really wrong. So if you ask somebody, how often do you go out to eat, they'll get that number wrong really quite easily. And if you go through the statements, there's a complete misalignment between what they think they're doing and what's actually going on from a cost perspective. So the question is, how do you actually specifically work out what your expenses are? And Dave Ramsey or Ramit would say, start with estimating, and then as you progress, get more and more accurate. But actually we can just borrow a formula from a cash flow statement from accounting, and the formula is net cash flow is equal to total cash inflows less total cash outflows. And if you just rearrange that equation and solve it for total cash outflows, you end up with total cash outflows is equal to total cash inflows minus net cash flow. And that equation, sort of making it comparable, or being able to look at a bank statement and figuring out what everything is, you can basically say expenses is equal to your ending balance less your starting balance minus your salary plus investments. So if you apply that specific formula to your bank statement, you will end up with what your expenses are precisely. And the great thing about a bank statement is the balance is always there. It's always visible. Let's just go through an example like this. Here's an example for January. I'm going to apply this particular formula. The ending balance was 580. The starting balance was 0. It was 0 before they got paid. Minus the salary, the 2,800, plus it back. So we're adding back the 340, which is the pension contribution and the stocks and shares ISA deposit. Those are investments. So we're adding that 340 back. When we do that, if you work that out, you end up with negative 1,880. And if you add up every single expense on this bank statement, you will actually see that those numbers match. Let's look at month 2. The reason why I'm doing this over multiple months is I wanted to demonstrate how you transition from one month to the next. So your starting balance is now the 580, which was your ending balance on the previous budgeting period. The ending balance for this period is 748. They earned one salary in this period, so it was another 2,800, and they invested another 340. So if you work that out, you get 2,292. We can do it for March again. The ending balance being 1,438. The starting balance 748, which was the ending balance for the previous budgeting period or the previous month, minus the salary again 2,800 plus 310 this time. The reason for the 310 is because they actually, in the last transaction on that list, they received a dividend income of 30. So we're taking that off what was invested. We're looking at net investments. So it was the 200, the 140, and then 30 came back. That leaves expenses, and you can check this as 1,800. So this is an interesting graph that you don't often see. It basically shows you cash flow over time. So it's showing you what the balance on the account is relative to time over the entire 3-month period. The spikes up is salary. The spikes down are things like rent or any other expenses. The bigger the drop down, the bigger that expense. And what you can see here is that the spike up is somebody getting paid, and then there's this gradual decline as the month progresses, and it gets to its lowest point, which is right before they get paid again. That will always be the lowest point on this graph. And if you apply the formula to the entire 3-month period, without looking at any of the transactions, without looking at any of the details, I don't need to know the price of coffee to do this calculation. The ending balance was 1,438. We know the starting balance was 0. We know it was 3 salaries, so that's 8,400. And we know the net investments was 340, 340, 310, and that comes to 990. So using that formula, the total expenses over that period was 5,972. That matches with adding up all of the expenses for each month, 1,800, 2,292, and 1,880. That comes to a total of 5,972. That matches, so you're almost checking to make sure. And if you really want to be sure, you can add up every single expense in all of those statements. So I also wanted to talk briefly about how to progress that. So now that you know what your expenses were precisely for each budgeting period, you can sort of get a typical range. So here for January and March, it was 1,800, 1,880, so in that 1,800 range. February stood out at 2,292. We can take a look and figure out what actually happened in February. I don't need to go through all the bills. I don't need to go into detail. I just need to look at why February deviated from my norm or my typical month. And the two things that immediately stand out here is dinner and a booked holiday in Spain. Those two things together came to 575. If you add 575 to the typical month, the January and the March, you will actually get values of 2,375 and 2,455. That's higher than what we actually got, the 2,292, which means that this person cut somewhere else in their budget. So there must be expenses in this month that were cut to make this lower than what we would have got if we didn't have the dinner and the holiday. The other way to analyze the budget is by looking at percentages of income. So you want to do this because you want to see what portion of your income is going to specific expenses. And you don't need to look at all of them, you only need to look at some of the bigger ones. And you're working your way down from the bigger values because you want to get an approximation or as close as possible in terms of understanding where your money is actually flowing to. And if there's any major concerns in the way that the money is being spent, that might differ from what you're passionate about, what you actually want to spend money on. Things that I like to say you care about. So rent here was 42.85%, and immediately that's a red flag to me. Your accommodation or living expenses should be somewhere between 25%, depending on who you speak to, where you get guidance, and then on the higher end maybe 28%. There are some people that say in the cities, if you're living in a really high cost of living area, you can go all the way up to potentially 32.5%. So immediately, if this was my budget, I would absolutely be focused on the rent. I wouldn't be worried too much about some of the smaller expenses. With rent, with council tax, with the holiday, with the credit card payment, just looking at those values there, we have 2 at 5.35% of income. then the 42.85% and the 17.85%. The other thing to note, those two extra expenses for this month, the holiday and the dinner, those two together are basically 20% of the income. So what I would be looking at with regards to rent is trying to figure out, how do I reduce that? Or do I need to negotiate with the landlord? And to demonstrate this, I just wanted to make a comparison between getting the rent down even a little bit versus trying to tackle things like groceries or the Tesco budget. The Tesco budget for this individual was only 125. So that's 4.46% of income. And if you look at that, even if they did, looking for the cheapest deals, looking for discounts, doing shopping comparisons, going to the shops with a specific shopping list and only buying what's on that list, even if they spent hours and hours every single month as an ongoing activity, they might at best get their grocery bill down by another 20%. If they did that, they would be saving $25 a pound, and that would be 0.89% of the salary. So that is not a lot of gain for potentially a really big time sink, really big investment from the individual, when they could reduce their rent by $30 or £30 by either moving or potentially negotiating with your landlord. And landlords are actually quite friendly to these types of negotiations, where especially if you have been a good tenant, you've stayed there for multiple years, in general, you could be in a position to go, I need my grocery bill cut by $30 or pounds. If you did something like that, you had that kind of conversation where it was like, either I'm moving or I need to save this money. A lot of the time a landlord's going to go, well, $30 or £30 isn't really worth it for me to have the place stand empty for a month or two, or even a couple of weeks. It's just not worth it. So they might even negotiate there, where you could be looking at them just agreeing to the lower rent. The other thing I did want to tackle in this formula was just debt. So yeah, there is a credit card payment for 150. We don't know when that debt was acquired. We don't know if that debt was them buying groceries this month and they cleared that credit card at the end of the month. So if that is the case, you can actually treat that credit card payment as an expense. So you can just treat it like, I bought stuff this month and I paid it off this month. So if you're not carrying a balance, it's an expense. If you were carrying a balance and you did use the money in the bank statement to clear a debt, then you treat it like an investment. So it doesn't count as an expense, because from my perspective, an expense is the interest portion that you're carrying. It's not the capital payment that you made potentially 6 months or a year or multiple years ago, where you bought a car, for example, or anything like that. So the interest portion or the monthly payment on an expense can still be counted as an expense, because that's the cost of having that item. I treat it like rent, but or if you own it, like a mortgage. But if you bought something 6 months ago and you're clearing it in a one-off payment, absolutely feel free to treat it like an investment. It should be excluded from your expenses because you paid extra into it. So it was your choice. It wasn't just an ongoing minimum payment or ongoing minimum cost. You made an investment into that. You chose to pay more than what was required. It wasn't an ongoing running cost, so to speak. And then final thoughts. This approach and this calculation works for any budgeting period. So whether this is 1 month or 3 months, as I've just demonstrated, or whether it is 6 months or a year or even 5 years, if I had all of the statements from 5 years ago and I knew all of the balances and I compared that to my balances today over that 5-year period, and I knew what my income was across that entire period, and I knew what my investments were for that entire period, I could precisely work out what my expenses have been over that entire period without looking at a single line item in the budget. This works for any number of accounts. It also works even if you're adding accounts during the period. It doesn't matter, because you're only interested in the total value across all of the accounts, whether they're positive or whether they fluctuate, it doesn't matter. So if you're adding another account and a new account and you're transferring funds into that account, then you're reducing the balance in one account and increasing the balance in the other account. That's also great to note for partners where potentially there's joint accounts or joint accounts and individual accounts. You can still get this holistic view of your expenses very precisely and very quickly without digging into all the detail. The other thing to note, it's a question I get fairly often, how do I possibly budget if I'm earning money irregularly? So I'm getting money every 2 weeks, every 1 week, or I'm a waiter and I'm getting tips, and that just comes in on an ongoing basis. How do I deal with this type of calculation or with budgeting, because I don't know what my income is, and depending on the month, depending on whatever period, my income is going to fluctuate and I'm constantly earning. Well, you look at it on a period by period basis and you go, okay, I want to budget every 2 weeks, or I want to budget once a month or once every 3 months. It doesn't matter. I'm going to look at the entire period. I'm going to look at my balances at the start, balances at the end, and I can just derive all of the details out of that. So it's great for somebody who has ad hoc income, and if you're a waiter and you're getting tips, then your income is going to be coming in bits and pieces. The great thing about this is it is super precise, and it can actually show you and reveal to you exactly what you're spending over any period. If you liked this video or you found it useful, please feel free giving me a thumbs up and subscribing, and even sharing it with anybody that you think would find this video useful or interesting, or specifically if they are starting out with building a budget. This is a great tool to have in their toolbox to actually analyze the expenses without feeling overwhelmed by looking at the price of coffee. And if you have any questions or requests, please email me at financialbasicsabc@gmail.com. See you next time. Goodbye.